All right, yes guys, welcome back to another YouTube video. All right, I hope everyone's doing well. In today's video, I'm gonna be breaking down the ICT silver bullet strategy. So we're literally going over every single little thing that you need to know, okay? From risk management, psychology, my A+ entry criteria checklist. We're also gonna be going over daily bias and the draw on liquidity. So we'll go over this very quick and short, brief PowerPoint. So get your notepad and pen out, take some notes, pay attention. And towards the end of the video, we're also gonna be breaking down this absolute banger of a trade that we took that ended up running for over 60 handles on NASDAQ. And we'll also go over a few more silver bullet examples so you guys can actually get a better understanding for this specific strategy. Other than that, let's jump straight into the video. All right, so starting off with the definition, someone that's completely brand new to ICT, has got no clue of what the ICT silver bullet even is an intraday setup, otherwise known as a golden opportunity, all right, that typically presents itself one time per day. We look to enter during a specific 30-minute time interval window known as the macro. Now, this macro is from 9:45 to 10:15 New York time. We're trading the New York session and we usually get an entry within that specific 30-minute time window. So during this macro, we're expecting for price to either have a significant move higher or lower, right, depending on the draw on liquidity. So don't worry if this sounds a little bit confusing to you and you feel like you know absolutely nothing about what's going on. We're gonna be breaking down literally everything that you can think of in the coming slides, all right? So stay tuned. Okay, first things first, before we get into the entry criteria or any of the technicals, we need to cover daily bias, all right? It's very, very important. And without daily bias, the best way I can explain it is you're trading blind. You have no idea where the market's heading, where is the drawn liquidity. You're literally just taking bullish fair value gaps, bearish fair value gaps, and hoping that it hits take profit. Okay, without a daily bias, you're simply gonna fail. So definitely don't skip over this and really pay attention. So number one, fair value gaps. All right, you're gonna look out for fair value gaps or inefficiencies on the daily time frame, preferably, okay? If you can't find any on the daily, you jump down into the 4-hour, and then you jump down into the 1-hour time frame, right? Don't really go below the 1-hour time frame. Stick to the daily and the hourly charts for inefficiencies, okay? These will give you a clear framework and daily bias to use for that specific trading day. So a bullish example, as you can see, I've drawn one out here. If price trades into a daily bullish fair value gap, your daily bias is gonna be bullish, okay? You can expect price to push higher and respect that imbalance. So once price taps into that daily fair value gap, the next drawn liquidity is going to be that daily swing high resting just above, which you can see got taken in the example. Now, a bearish example is just going to be the opposite of that. So if price trades into a daily bearish fair value gap, your daily bias is of course going to be bearish, and you can expect price to respect this imbalance and push price even lower towards the already existing drawn liquidity. So usually what will happen, right, price will tap into a inefficiency, let's say for example a bearish one, and if it's respecting that gap, you can expect price to go to the next daily swing low. That can act as your draw on liquidity. Now we can also flip this completely, and let's say the daily actually inversed that fair value gap. So let's say we have a bullish fair value gap, like in this example here, and the next daily candle inverses that gap and actually closes below, meaning it's been inversed. Going into the next trading day, now you can have a bearish bias instead of a bullish one, because obviously we've not respected that bullish PLRA and we've in fact inversed it. Okay, so it's pretty simple, guys. A lot of people, they like to overcomplicate daily bias on YouTube. There is really not much that goes into it, okay? The main thing that you want to use for daily bias is going to be fair value gaps. So if there's no fair value gap on the daily time frame, go down into the 4-hour. If there's no gap on the 4-hour, go down into the 1-hour. And usually you will find some sort of imbalance on that time frame. If for any reason you don't find any imbalances on any of these time frames, then you revert to the draw on liquidity. So wherever the draw on liquidity is, it's gonna act as your bias. For example, let's say we have a new week opening gap resting below and price has opened up higher. Your draw on liquidity and daily bias for that whole week is most likely gonna be bearish. And you're gonna expect for price to draw down into that new week opening gap throughout the week. All right guys, apologies for interrupting the video here. I've got some very big news. I've opened up a few seats for the one-on-one mentorship program. I'm only looking to take on a few serious individuals to work with me one-on-one, actual private calls where you have direct access to me. So you'll be working with me one-on-one where we literally break down everything. We build a personalized plan specifically tailored to your current trading struggles. We're gonna have a look at what you've done right, what you've done wrong, and we'll figure out where you can improve in order to get to that next level. So you can finally start to see some results like getting funded and even getting your first ever payout. So yeah, if you are someone that's interested and you're looking for a mentor to guide you every single step of the way, make sure to fill out the application form in the description below. It takes less than 30 seconds. We can see if you're the right fit for this mentorship. If you are, you'll get approved and we can speak shortly. But yeah, other than that, guys, let's get back to the video. Okay, so drawn liquidity, let's go over some points that can act as a magnet for price. Number one is going to be session liquidity, right? Things like London highs, London lows, Asia highs, Asia lows. These are major liquidity levels that can act as a draw on liquidity for price. Number two is going to be relatively equal highs and relatively equal lows. This is a very strong magnet on price and is one of the strongest draws on liquidity. Now, the reason for this is because we have retail traders, right, that trade support and resistance, supply and demand, these types of concepts. So these traders are looking at levels of support, for example, to act as support and bounce and push price higher, right? Whereas we're expecting for price to actually attack that support and go through it, right? So what we see as relatively equal lows, these traders are seeing as support. Hence, it's such a strong magnet on price and one of the strongest draws for liquidity. Now, usually when we see equal highs, equal lows, guys, it does not stay like that for a long time, okay? It usually gets taken out very, very quickly. So when you do see that, make sure to take advantage. Okay, number three, external buy side and external sell side liquidity. These are significant levels outside of the range, usually on the higher time frame, that can act as another draw on liquidity. So how I like to look at it is, let's say you're coming to the next trading day and you mark out your previous daily low and your previous daily high. That's going to act as a current price range for that trading day. And usually these levels will act as external buy side and sell side levels, meaning they're outside of the range. When one of these levels gets swept, usually you find the best and highest probable setups inside of those areas. Number four is going to be internal buy side and internal sell side liquidity. An example of this is a unfilled imbalance or fair value gap that are resting either in a premium or in a discount of the most recent and current price range. So what do I mean by that, right? If we have that price range, the previous daily low and the previous daily high, we have the external levels marked out, right? Anything internal is obviously going to be inside of the range. If we find a fair value gap that's not been tapped into yet and is actually sitting in a premium or in a discount, let's say you're going long, you're targeting a premium, you can target that inefficiency resting in a premium as your draw on liquidity. Same goes for if you're shorting and you're targeting a discount. You can target that fair value gap, which is unfilled, resting below 50% inside of a discount, okay? These will act as your internal draws on liquidity. Now, the final draw on liquidity and also the most strongest draws for liquidity is going to be the new week opening gap, okay? Whenever we have one of these form, it usually tends to act as a magnet for price very well. So it's Friday's New York close and Sunday's opening price. That difference is what we call the new week opening gap. So the algorithm sees this as unfinished business and wants to fill that gap. So for example, if price opens higher on Sunday and leaves a gap below, that imbalance becomes a downside draw on liquidity, meaning we're most likely gonna be bearish throughout the week to target that inefficiency. Vice versa, if price opens lower and leaves a gap above, you're gonna be bullish instead, right? Now, I'm not saying it's gonna get there within a few minutes or within one day. Usually a new week opening gap acts as a drawn liquidity for the whole week. All right, so I've had to make the face cam a little bit smaller because it doesn't actually fit on the screen. But anyway, risk management and psychology, very important. We're gonna be going over everything that you need to know about this, okay? So maximum amount of trades that you're gonna be taking with this strategy in a day, and with any strategy that you're trading really, you should only be taking a maximum number of 3 trades in a day. If you take one loss and one break-even trade, you can allow yourself to take that third trade. Whatever the outcome is on that third trade, whether it's a loss or break-even or win, you're calling it a day, okay? You're not taking anything more than 3 trades. Realistically speaking, guys, if you're making a financial decision or investment, which we are, okay, because we're trading intraday, your mental and your brain has to be switched on. Now, usually the amount of decisions in a day involving financial risk include around 2 or 3, and you shouldn't be going over that, because once you go over that, you're more likely to become emotional, you're more likely to revenge trade, and you don't really know what you're doing. You want to focus on being a sniper rather than a machine gun. So yeah, the maximum amount of losses in a row you're going to be taking is 2. So if you take 2 losses in a row, that's it, you're calling it a day, you're walking away. If you take 1 loss, 1 break even, you can allow yourself to take that third trade. Now, the maximum amount of risk in handles on NASDAQ that you're gonna be trading is gonna be 30 handles, okay? No more than 30 handles. Now, I've given you 2 examples here. So one top step example and one apex example. So for a 150K account with top step, the position size that I recommend is going to be 15 micros. So if you take one loss on 15 micros, you want to half your position size and you stay at half position until you get your next win. Only when you get your next win, then you can go back up to the original position sizing of 15 micros. So that will stop you from blowing accounts. Most people, when they take a loss, they actually double their risk and they increase their risk, okay? I don't see the point of that. Why would you increase your capital when you're clearly wrong and you're doing something wrong in the market, you're taking a loss? You need to step back, reduce size down, and stay at that size until you get your next win. Once you get your next win, only then can you increase your size back up to that original position size of 15 micros. That's an example for a 150K account with top step. A 50K account with apex, the position size I'd recommend is 8 micros. You take a loss, you go down to 4 micros. Same thing, half position, you stay there until you get your next win. Only then you increase it back up to the original amount of 8. So you can use this apex example with top step as well, but that is just my recommendation. That's what works the best, and that's how I started out as well when I was trading these accounts. So 50K account, I'll be risking around 8 micros. A 150K, I'll be risking around 15 micros. Now, also a very big tip with psychology that you want to keep in mind is simply accepting the risk. So what does that mean? Every single time before I enter a trade, in my head, right, I'm accepting the amount of risk in dollars. So let's say I'm risking, for example, $500 on a trade, right? Before I enter that trade, I'm telling myself, I'm accepting this amount of risk, $500. I don't care what the outcome is. I don't care if it's a loss. I don't care if it's a break even. I don't care if it's a win. Whatever the outcome is, I don't care. I'm not going to be more happy or more sad depending on the outcome, right? And matter of fact, you actually want to accept a loss before you even take that trade. So before you take that trade, you're accepting that $500 that you've just risked on the table is no longer yours, okay? Whatever happens with that, you don't care. That way, you've already accepted the loss before it's happened. So let's say you do take a loss, you're not gonna be as disappointed compared to someone who hasn't done that, because in your mind, you've already taken that loss beforehand, right? Someone who hasn't done that though, they're gonna be more likely to revenge trade, they're gonna be more disappointed because they're actually expecting a positive outcome, such as a win, rather than expecting a negative outcome. Okay, I know it sounds stupid, guys, but always expect a negative outcome. When you do take a win and you're expecting a negative outcome, you're actually going to be more relieved, more calm, more relaxed because you haven't taken that loss. So that's one tip that really helped me with my psychology. And of course, everything that you do outside of the charts is also going to impact your trading in the charts. So make sure to have good habits, right? Get yourself in the gym. Don't be going out every night, drinking, partying, smoking, all these types of bad habits. Avoid and actually work on yourself, and all of that will reflect in the chart as well. Okay, so lastly, the source. The main thing that most people are waiting for, okay, on this channel. The A+ entry criteria model. I know you guys love this, so let's get into it, all right? Number one, a sweep of liquidity, okay? So this can be any buy side or sell side. It's gonna be 10 times better though if we sweep, for example, session liquidity, such as London lows, Asia highs, Asia lows, etc. So that's number one. That's what you're looking out for, is a sweep of liquidity. Now, if we're strictly talking A+, then you want to look out for session liquidity to get swept. Number two is a displacement in the opposing direction. Now, you want to see a displacement on both assets. So meaning if NQ is displaced, but ES has not displaced, you're not going to be taking that trade. Okay, you want to see displacement on both of the correlating assets. Number three is a market structure shift, a break above a swing high or a break below a swing low, preferably with a strong candle closure. Now, if the candle doesn't close above the swing high or below the swing low, it's still a valid trade. However, it's just less likely to play out. So trading is all about probabilities. If you see a market structure shift without a strong candle closure, yes, it's still a valid trade. It's just less likely to play out. It's less probability. Just keep that in mind before taking trade. Okay, if you are very picky, make a rule for yourself. Only take market structure shifts with strong candle closures. Now, in my case, I'm not that picky, and we actually took a banger trade yesterday, had this exact same example, which we will break down in just 1 second, and we didn't get strong candle closure, and we still hit TP. So it really depends on the scenario. Number four, you want to have a fair value gap, which is overlapping with a breaker block. Now, I know this is referred to as the unicorn model. Now, I've just included it because that's what I look out for when I'm trading anyway. And the silver bullet criteria with that strategy compared to the unicorn is very, very similar. Okay, it's literally the exact same thing. I'm looking for all of this I've just laid out for you today. With the unicorn model, all I'm looking for is break a block. So it's very similar. They're pretty much the same exact strategies. I've just decided to include all of that together in one. Preferably, you want to look for a fair value gap that's paired with a break block. That's going to be your entry point. If there's no break block, that's fine. You can enter off the fair value gap. Just know, again, it's going to be less probable. So the highest probability trade, what you want to see is a fair value gap that's paired with a break block. That is your entry point. So next, you want to look for a market structure shift, displacement, fair value gap. All of these things, they must show on ES. Both of the assets must be correlated. And if you see a market structure shift on NQ, but there's no market structure shift on ES, that's not valid. Same with displacement, same with a fair value gap. If there's a fair value gap on NQ, but there's no fair value gap on ES, there's no trade. Entry must be inside of the 9:45 to 10:15 macro or the 10:45 to 11:15 macro. Okay, this is a must. It has to be in there. If it's not in there, it's not a valid trade. That's not something I'm looking to take. Doesn't matter if it's 1 minute before or 1 minute after. Okay, it has to be inside of that 30-minute time interval. Now, stop loss placement, either above a swing high or below a swing low, not risking more than 30 handles on NASDAQ. If you're trading ES, and finally, you want to target the opposing draw on liquidity. This can be London lows, Asia highs, new week opening gap, etc. And one thing I did actually forget to mention on this PowerPoint is the time frames to use. So for analysis, the 15-minute time frame is the best time frame to be using to mark out your current price range, your session liquidity, or your draws on liquidity. The 15-minute time frame, obviously keep in mind your higher time frame like the 4-hour, the daily, those levels also marked out. But generally speaking, the 15-minute time frame is where you can mark out the majority of your analysis on. Now for entry time frames, the maximum time frame that you want to be using is the 5-minute time frame. So anywhere from the 1 minute to the 5 minute, okay? If you don't see a gap on the 1 minute, you go to the 2 minute. If you don't see a gap on the 2 minute, you go to the 3 minute. If you don't see a gap on the 3 minute, you go to the 4 minute and so forth, okay? But always start on the 1 minute. That is the best time frame to be entering on when trading this specific strategy. All right, guys, but other than that, we've literally covered everything that we need to know. So now we're gonna be jumping into some live trading examples. We're also gonna break down the trade that we took the other day. So let's jump straight into that. All right, so let's break this trade down that we took the other day. Going into the morning, okay, we had this price range, which is quite large, okay? And notice how we're inside of Thursday, right? This is Wednesday, okay? This is the lowest low that happened inside of the previous day. So this will act as our previous daily low. The previous daily high actually got taken, but we had some London highs up here. So this is gonna act as our price range, right? So what I like to do is I measure from the swing low to the swing high. That is our price range that we're working with. You can see if we're in a premium or if we are in a discount. So what I was looking for going into that day was to have this 15-minute gap here act as our draw on liquidity, right? So I wanted to see price reach back into a discount. Now, going back to the point that I made on the PowerPoint, this can act as an internal draw on liquidity, right? Because it's a fair value gap that's not being tapped into and it's resting inside of a discount. So if price is in a premium, what is the next logical move for price to do? It is to move back into a discount, okay? That's how price moves. It goes from premium to discount, from internal range liquidity to external range liquidity, okay? That is how the market moves. So I wanted to see price go back into this gap and act as our draw on liquidity. Now, once it had already retraced and the objective had been met, I switched my bias completely and I was actually looking for longs, right? To target these equal highs up here, which will act as our external draw on liquidity and potentially as well 50% of this current price range. So I wanted to see at least price come up, take out this swing high, which will act as internal buy side, and also tap into 50% or a premium of this price range. So if we just play it back here, as you can see, price came up, we broke above a swing high that actually was formed inside of a bearish fair value gap, which is a very good market structure shift. And this market structure shift is actually high probability compared to just breaking any swing high or any swing low, okay? If a swing high is formed inside of a bearish inefficiency and has already rebalanced that gap, and then it gets broken through, that is a very high probability market structure shift. So once I've seen that, yes, we didn't get a candle closure. However, this trade is still valid, okay? So the next fair value gap, I decided to enter. Stop loss goes below the swing low. And as you can see, there are 2 gaps in this scenario. So some people would ask me, which gap am I going to choose? It's always going to be the first gap you want to be entering off, okay? Now, let's say that first gap doesn't give you a valid stop loss of 30 handles, then potentially you can enter off the second gap, okay? But as long as you have a valid stop loss of around 30 handles, okay, and you can have your stop below the swing low or the displacement candles low, risking no more than 30 handles, that is a completely valid trade to take. So I had my entry at the edge of that gap. My first TP was at that internal buy side level. Second TP was at 50% of the range. And then final TP was at equal highs. Now, as you can see here, we actually ended up hitting TP1 and we also hit TP2 as ES already retraced into 50% of the range. So once ES done that, I closed a further of my position off and I actually trailed my stops to this swing low here. So as you can see, we got stopped out in a profit, but we scored around 60 handles there on that trade. And that final contract that was supposed to obviously run to equal highs got stopped out in a profit, which is completely fine. We made the majority of our money with those contracts. I like to leave one as a little runner just to see if we do get that final TP. But yeah, other than that, all good. And I'll be honest, guys, there has not been much opportunity the past 2 weeks, right? And sometimes when you're trading, that is what you have to deal with, right? You have to have patience. Some weeks, even some months, you're not going to be taking any trades. The best traders that I know and the most profitable traders that I speak to on a day-to-day basis, okay, they take around 1 to 4 solid A+ setups every single month. That's not a lot of trades in a month. And that's also why I've not really been posting lately, guys, because there's been nothing to post. There's been no trades. I've not taken a single setup within the past, I'm not sure, around 10 days. This was the first actual trade that I took and it actually aligned with my model, right? It met my entry criteria, everything was aligned and it was a valid trade to take. Whereas the past 2 weeks, there's been no single setup that I've looked at and said, yeah, that's a valid trade to take. So I've literally just been sitting on the sidelines waiting for a A+ opportunity. All right, guys, so as I'm actually filming this video, okay, I had to come off because I had to trade live. The market was opening, so I had to stop filming the video that I'm currently filming. But we actually ended up catching this banger of a trade which ran for 90 handles. So I'm going to quickly add this into the video and I'll break it down. So going into the morning, right, the drawn liquidity was these daily equal lows here. If I actually zoom out, you can see on the 15-minute time frame, these stacked up lows here. That was the draw on liquidity for me going into that day. So I was definitely bearish. However, price came down and we got so close to those equal lows where it didn't really make sense for me to start shorting in a discount, right? You're gonna be shorting inside of a premium. So what I waited for is a retracement back into a premium of this price range here, right? So as you can see, we have a 15-minute bearish fair value gap. Now, yes, you can go long, right, and target the premium and catch the retracement leg. That is very risky, but you can do that. Now, did we get a valid trade on the 1 minute time frame to catch that retracement leg? No, we did not, right? There's no entry here. There's no valid opportunity or trade, right? Price just trickles up slowly and retraces into a premium. So there's no actual valid trade inside of that price leg. Now, we waited for that secondary macro. Once price came back into a premium inside that 15-minute fair value gap, we then got that next displacement, okay? So we have a mitigation block here as well that is paired with that fair value gap. Now, notice how we got entry exactly at 10:45 a.m., which is inside the macro. Stop loss is above the swing high, risking 29 handles, right? So we're not risking more than 30. Risk management is on point. We enter short. As soon as price breaks below this swing low, we start trading our stops, right? Reducing risk. First EP was at this low here for around 70 handles, I believe, where we closed off 80% of our position. And then we trailed our stops. Second TP was supposed to be this fair value gap here, resting in a discount, which we never actually got to, and we ended up getting stopped out in a profit, securing ourselves over 90 handles on NASDAQ. You know, what an amazing way to end the week on a Friday. It's amazing, guys. When you catch a banger trade, especially on a Friday as well, great way to end the week. So we're closing out this week in around 120 handles in profit, I believe. Now, bear in mind, guys, as well, we have not traded for the past 2 weeks because there's simply been no opportunity. Now, this is the power of patience, right? You don't trade for 2 weeks and then boom, the first 2 trades that you take are both bangers and you close the week in a huge profit. So very happy about that. We are coming towards the end of the video here. So hopefully you found this video insightful. Hopefully you actually found some value out of this and you learned something. If you have, please leave a like, leave a comment, share and subscribe. And lastly, if you are really serious about getting your trading to that next level and you're looking for a mentor to take you on board and actually teach you everything from A to Z, actual one-on-one private calls where you get direct access to me, we figure out, right, what you're doing right, what you're doing wrong, where you need to improve in order to get to that next level and actually build a personalized plan around your current trading struggles. If that sounds like you and you are someone that's actually interested, make sure to fill out the application form in the description below. We can see if you're the right fit. If you do get approved, then it will allow you to schedule a call with me where we can speak over the phone and get you onboarded ASAP. So yeah, other than that, guys, I hope you lot enjoyed the video and I'll catch you lot in the next one. Take it easy.